You thought your exotic car was a good hedge against inflation? Well, you are right for the last year, but not for the last month. The inflation-adjusted prices saw their first drop after 15 months of consecutive price increases, and the last time that we saw a run-up with such a momentum was during the late 80s. But that price bubble crashed quicker than your latest meme stock. So are we currently in a bubble similar to the late 80s, and will prices come crashing down? Or will it be different this time? Experts rated this market as the hottest one in nearly a decade. Collectible car sales were at an all-time high, private sales are through the roof, and also auction activity is sky high thanks to the successful online auction platforms. Let's have a look as to what we can expect in the future. The collectible car market is perhaps best measured via Hagerty's market rating. I read a lot of material about car values, and the material from Hagerty is usually top-notch, and so is their market rating. In case you don't know Hagerty, they are a niche insurance agency for collectible cars and have grown to the largest membership organization for car lovers. Their affinity for numbers is then also reflected in their market index. It's not just based on the average over time, it's more rounded and therefore a little bit more complex. Consequently, it's less intuitive than the average over time, but much more reliable as it filters out a lot of noise. Their market rating conveys the classic car or collectible car market performance as a number that can sit between 0 and 100. And you won't be surprised to find out that the higher the number, the hotter the market. Most of the time, however, it's likely that the score sits between 40 and 60. The scores over time are namely expected to follow something called a bell curve. And this means that over time, scores are most likely to fluctuate around the mean of 50, while the chances of being higher or lower than 50 decrease symmetrically when you move away from the middle. An additional benefit of this is that the rating moves fluidly in the 40 to 60 range, but becomes much more difficult to move at its extremes. Pretty fancy stuff if you ask me. But how does the rating development over time look like? Well, if we look at that development adjusted for inflation, we can see that the market rating dropped for the first time since March 2021. Yet, it is still very close to its all-time high. The only other time prices increased with this speed was after the financial crisis. But the starting position was completely different back then. The index was below 50. However, at the end of 2011 there was a slowdown, and then it took 3 years for the index to move from a score of 60 to 1/70. And this further reinforces the idea that the recent surge is unprecedented and that values are very high. So what exactly caused the market rating to drop after such a strong run-up? Hagerty does not provide the exact way in which the rating is calculated, but they provide enough information to get a clear idea. You see, the index is rather smart as it uses the weighted average of 8 different components, and these are in order of importance: the Hagerty Price Guide editorialized values, auction activity, expert sentiment, Hagerty Price Guide indices, private sales activity, insured values for the broad market, insured values at the high end, and correlated macroeconomic indicators. Are you still with me? Now I won't bore you with all of them, but let's discuss the 3 most important reasons why the market rating decreased. Many of the macroeconomic indicators that are part of the index are down. Think about the S&P 500, the price of gold, and even the home price index is slowing. Hagerty knows that there's no direct causation between these macroeconomic indicators and the collectible car market, but there is some form of correlation, hence the inclusion. Second on the list is the decrease in the private sales activity. As an insurance company, they can request data from their customers and this gives them unique insights. They for example know when customers are increasing or decreasing insured values or when they call for a quote. Concretely, this means that they use a moving average of the private sale price in combination with the percentage of cars that sold for more than what they were insured. Interestingly, the private sales activity still increased in absolute terms, but decreased when you correct for inflation. And this decrease is of course what we can see back in the market rating. Finally, we have the drop in auction activity that consists out of the number of cars sold at auction and the median price of the car sold. The number of cars sold is actually at a record height, but the median sales price is slightly down in absolute terms. And this means that the price, adjusted for inflation, is actually the lowest since October 2020. So the moral of the story over here is that many indicators are still at extreme values or very close to extreme values, but that inflation outpaced them. And this in turn caused a drop in the inflation-adjusted market rating. Nevertheless, the story is clear. The collectible car market is still very hot. Prices and quantities are at extreme levels or very close to extreme levels. However, we can see the first signs of the market cooling off. The inflation-adjusted market rating is cooling down, and underneath the rating we saw that the median auction sale prices are also cooling off. Moreover, I've been showing to you for the last 6 months that price trends for median asking prices for popular sports and supercars are flattening. Let's look at a few examples to make this story a bit more relatable. And we start with a car that is loved by almost all petrolheads, the 991 GT3. But I would like to get your attention for today's video sponsor before we look at the price trends. Today's video is brought to you by Exclusive Auctions. Exclusive Auctions is a new full-service online auction and classifieds marketplace platform for buying and selling exotic cars, race cars, sports cars and specialty vehicles, and they have many really great features. With their gold listing package, sellers pay 0 listing fees and receive 100% of the selling price of their vehicle. They offer full service after-sales support with everything from pre-purchase inspections and transport services to escrow services, ensuring a safe and secure transaction for both buyer and seller. Click on the link below or go to exclusiveauctions.com and register to bid or list your car for sale today. But now then, let's continue by having a look at some flattening price trends for the median asking prices. And as I said, we start with the 991 GT3. We can clearly see that after a big price surge, values are flattening. Dot ones even saw a price decrease. Now the same pattern is visible in the 488 market, F12 market, California market, BMW i8 market, Alfa Romeo 4C market and 991.2 Carrera S market. I could go on and on, but I think that you get the point. Yes, prices are flattening and they have been doing so for a couple of months. Now before you start raging to me in the comment section that prices are not coming down, they are indeed not coming down for most models. It is the price increase that stopped, and it stopped across the market. So this means that if you have a look at the price trend for a car, it's very likely that you will find the S-shaped pattern. It does not mean that you will find it for all cars though. There are some cars for which the upward price trend is still intact. We saw for example in the Q2 mid-engine Ferrari update that 458 prices are on fire. Now based on everything that we just saw, so the development of the Hagerty market rating, the underlying indicators, and the S-shaped pattern in the median asking prices, I think we can conclude 3 things. The price run-up during the last years was unprecedented and extreme. Prices are still very high and we can see numerous signs that the market is slowing. Or in the words of a typical YouTube video title, the exotic car market bubble is about to pop. The question is of course, will it? The recent run-up in prices might you remember about the Ferrari price bubble in the late 80s. That is, if you are a little bit older than I am. I wasn't even born back then. If we look at the Ferrari market index that is calculated by Hagerty, we can see a large increase starting somewhere around 1987, followed by the popping of the bubble in the beginning of the 90s. Compared to more recent increases, it does not look so impressive, but it does when you look at the percentage increases. So what exactly happened here, and can this market dynamic teach us something about the current market? Let's look a little bit deeper into the Ferrari price bubble. First of all, there was a stock market crash also known as Black Monday, so people were a bit done with paper and preferred hard assets. Second, the world was dealing with a strong yen, hereby attracting buyers from overseas. It suddenly became international. However, the largest contributing factor might be the change in the way people saw these cars. As prices started to go up, the cars were bought more and more for investment purposes, or in other words, they were bought by speculators. This in turn drove the market up further and in some cases increased prices by a factor of 10 within a time frame of 1.5 years. As a Ferrari dealer noted, in 1985 everyone involved in the collectible car market was an enthusiast. In 1989 they were all speculators. Eventually of course the inevitable happened. The market ran out of buyers. The Japanese bank raised rates, the money flow from property price increases dried up and people ran into financial trouble. All of this was exacerbated because many people lent money to buy a car, and with prices coming down, the car's value was less than the outstanding loan amount. Fire sales increased and market supply was too high for the demand and prices came crashing down. As we saw from the price graph, prices did eventually bounce back, but it took around 15 to 20 years. The whole market dynamic is rather fascinating, and I highly recommend to read Hagerty's article on the history of the Ferrari price bubble. I'll put a link down below in the video description. But now then, are we in a similar situation right now? Well, to be honest, it is very difficult to say. One can make a comparison among various dimensions which may or may not be relevant in the end. Moreover, within the collectible car market there are various segments, and they might move different from each other. Since this is a YouTube video and not a PhD dissertation, I chose for the less rigid approach. I just listed a few similarities and differences between the current market situation and the situation in the late 80s. There are namely a few similarities to the 80s crash, and one of them was also pointed out by Hagerty. Many people who used to be on the sidelines of the market are now in it. During the lockdowns, many people got more free time and money, and it turned out that this was a good recipe to increase demand for sports or collectible cars, especially for the lower end of the segment. Many people who always wanted one bought one during the first lockdown. Now that living costs are increasing, luxury items like the car that was purchased during the lockdown might be the first thing that has to go. This of course increases supply and pushes prices down. Another thing that is similar to the 80s price bubble is that many vehicles are financed. But this is a tricky thing to talk about without having the numbers. We know that some everyday cars are financed with an LTV over 100%, but financing a collectible car is a different story. The higher you go on the price level, the more custom your terms and conditions and the more specialized the lenders. Hence, it is difficult to say how similar the current situation is to the one in the 80s. Did people take out loans to speculate on value increases in collectible cars? We can only say that with low interest rates, many collectible cars are financed. Now Hagerty commented that compared to the 80s, the current market has more passionate buyers, as not only the cars with investment potentials are bought. I can't really judge this, but I find their argumentation that there are now more online enthusiast groups and events not too convincing. So in some way the situation today is very similar to what we had in the late 80s, but there are also important differences. First, the market for collectible cars is much larger and much more transparent than in the 80s. Think about all the auction websites where you can browse cars and track prices. Or even the fact that this YouTube video exists. Buyers are much more informed and know much better what they are buying and at what price level they are buying. I think that everybody is aware that prices are currently very high. When prices decrease, there might be enough people on the sidelines who are happy to get into a car at a lower price point, hereby dampening the fall. On the flip side though, you could also argue that this transparency increase causes a spiral effect when things do go south. Another thing which is different from the 80s is the number of opportunities to make a quick buck. If you are looking to make money quickly or lose, depending on your skill level, you can buy the next promising NFT or crypto project, all from the comfort of your home. These opportunities did simply not exist in the 80s, so one could argue that people who are looking to make a quick buck start somewhere else than in the collectible car market. Finally, even though that many cars are financed, we need to recognize that the lending standards are higher than in the 80s. There are of course some differences geographically and also in the different price segments in the market, but it's fair to say that the standards are higher than in the 80s. That is not to say that they are perfect, just higher than in the 80s. And all of this of course decreases the chance of having a high number of fire sales, hereby flooding the market. So are collectible car values heading for a big crash like we saw in the late 80s? As I also shared with you in my previous video, I like to think in scenarios with probabilities attached to them, instead of plain forecasts. Based on the previous argumentation and the current price movements, I think that a full-fledged crash is an unlikely scenario in the near-term future. In my opinion, it's much more likely that we will see flat price developments or slight price decreases of let's say up to a maximum of 10%. But admittedly, this number is chosen rather arbitrarily. But what exactly does this mean? Flattening or slightly decreasing price trends? First, it means that the cars that used to have a mileage sensitivity will return to this sensitivity. So if you buy a GT3 and add 10,000 miles, you're likely to lose some money on it. Also, if you park it in your garage for a long period of time, the depreciation per year will eat away some of its value. Second, I think that the price records at auctions had their best days. There will be less excesses. Expert sentiment is still positive, but has been declining. Many people realize that these insane price increases are over now and that the market is shifting into a new paradigm. But this is of course my opinion, and I might be wrong. It might be so that things change in the upcoming months and that the probability of a crash increases. I therefore highly recommend to subscribe to the channel so you stay up to date on the latest movements in the market you are interested in. After all, I think that these flat or slightly decreasing price trends go for the majority of the market, but as we saw earlier in the video, there are always exceptions. But what do you think? Are we heading for a big crash or will prices settle at current levels? Let me know your thoughts down below in the comment section. Now before we end the video, I want to highlight that the video covers the collectible / sports / supercar market. That's already a highly diverse group in itself, but it does mean that your everyday cars are not covered. You can click over here if you want to get a price update for your everyday used cars, or if you wait a moment, click again over here if you want to get a price update for the new car market. And with that we arrive at the end of the video. As always, thank you for watching, and if you enjoyed this video and would like to support the channel, please click on the like button down below. Thank you.